The webinar itself is going to be around financial planning in 40s and how we can build our wealth whilst living a great life, which is obviously the really important thing and what we will all want to achieve. So I'm hoping it's going to be around between 30 and 40 minutes long. It's probably going to be closer to 40. And if people are there, I've got some times for some Q&As at the end. If you've got any questions, do just fire them in the comments as we go through. So I'll come to them at the end, or if I don't get around to answering them, I can then use them and I'll create some content around it, which will hopefully be useful for people. Just some disclaimers, really. This is information only. It's not intended as advice. I'm going to cover off some kind of ideas, and hopefully the idea is to get people thinking about their financial planning, thinking about what they should be doing, what their options are, but it's not specific advice, which should be based on your individual circumstances. So really important to understand that. And investments can go up as well as down, and any growth rates are just examples only and just using to illustrate a point rather than any sort of guarantee or anything like that. So in terms then of our agenda and what we're going to be looking at, we're going to focus on obviously why your 40s is a good time to be doing this. The life planning side of things, cash flow, insurances, touch on investments, can't go into too much detail, but touch on investments, the tax planning side of things, estate planning as well, which is really important. So before I kind of delve into the meat of why your 40s are a good time to start your wealth build, I want to share like a little example. So I'm 42. I recently headed into my 40s, and someone uses the analogy of a 2-week holiday. So if you think of when you go on holiday, you get there, you're a bit stressed, it takes you 2 or 3 days to really unwind. Then you start really enjoying it. You're about a week through and you think, oh, this is great. I've got a whole week to go. I can really enjoy my week and do all the things that I want to do. And then snap your fingers, a week later, you're on your plane home and you're thinking, where did that second week go? Now, from a life perspective, the majority of us, if we're in our 40s, are now in our second week of our life. Okay, so I don't know if you find it like me, time just goes by so quickly. It's absolutely just racing by. This year has disappeared. It's only going to get kind of quicker. So it's really important that we start being intentional around our plans, the life that we want to live, our financial planning, because we are in our second week. If we look at the average life expectancy of being maybe sort of 80s, 85 on that side of it. So unfortunately, we're second weekers and we need to start taking action and really getting in control of our finances, but also creating that life that we want to live. Okay, so why are your 40s a really important time to be building that wealth, or your sort of peak wealth building years? There's a number of reasons for it, but I think these are sort of the key ones. You're likely at or close to your sort of highest earning potential. You're probably quite far advanced in your career, so that's going to create opportunities with your higher income. Potentially you've got a bit more financial stability, you've got a foundation that you can build upon and a starting point, and you can now start to take kind of steps towards achieving the things that you really want to do. Although we are second weekers, time is still on our side from an investing standpoint. If early 40s and you potentially wanted to stop work at 60 or 65, you might have a 10, 15, 20 year time horizon to be investing. And equally, actually, longer term, you'd be investing beyond that. So you could have a 30, 40, even potentially 50-year time horizon from investing. So that brings its own opportunities in terms of the things that we can invest in and the level of risk, which I'll touch on in more detail, that we can take over the next few years. You're more experienced. What's worked in the past, what's not worked for you. So you've got that experience. Any mistakes that you've made, you can learn from them and start moving forward with time on your side. And I think more focus in terms of starting to think about the future and what you want to achieve and what's important to you and what does a great life look like, but actually in a position to say, actually, I want to be thinking about this. I want to be taking steps. I want to make sure that I'm doing the right thing. And certainly for me, my attitude towards things has changed a lot in my 40s. I'm definitely thinking more about the future. In my 20s, I didn't really care. 30s, was busy with young kids and just the day-to-day. But now in the 40s, it's more about, okay, what do I want my life to look like? What's my purpose? And I'm really focusing on that side of it. And if you are earning a higher income, potentially that does create more planning opportunities. And then you've got the ability with that time frame to take more investment risk and a higher capacity for loss as well, which helps in terms of trying to generate the returns that you might need. And ultimately, what we want to be doing is building our assets, as this very sort of simple graph on the right shows, in terms of taking advantage of compounding returns and building up our assets over the next few years to really put us in a strong position further down the line. And the sooner we take action, the better that future is going to look. Okay, so what is financial planning? This is kind of my take on it, in terms of it's about understanding where you are now and then where you want to get to in the future and what you want that to look like. And financial planning is essentially the bridge between those two elements. Where the challenge probably comes from is not understanding where you actually want to get to and having taken the time to understand that. And sometimes it's getting real clarity over what position you're in now. But once you know that, you can start to understand what actions you take to bridge that gap between the two. And I've shared a very simple timeline at the bottom with some potential life events that could happen over the next few years. I'd encourage anyone to do this. I think it's a really good planning approach, is to essentially take your age now and then maybe put 60 or 65 whenever you want to potentially stop work. Or for most of my clients, it's helping them make it so work is optional, and just chart some of the life events that might happen along the way. So it might be sending kids to private school, or a change in career, starting a business, sending the kids to university, selling a business. There's a number of life events that we can probably expect and prepare for. But equally, there might be events that happen to us over that time that we weren't expecting. And I've not put them here, but, it could be things like divorce or suffering ill health, things that are really going to impact. So there are things that you can plan for and prepare for when it comes to life events. And sometimes it's stuff that you need to repair after they've happened, because we don't know exactly what the future is going to look like. We don't know what's going to happen. A lot changes, best laid plans and all that. But it's a really useful starting point to understand what potential events are going to happen, because you probably find that the majority of them have some sort of financial impact upon them. So I think a really good exercise for people to do when it comes to their financial planning. Okay. So for me, this is a step that I think people overlook, and they rush into the facts and the figures and what should I be investing in and what pension do I need and all that kind of stuff, without actually taking a step back and thinking about that bigger picture and that life planning bit. And money is the fuel. It's not the destination. The goal is not to have more money. It's to have more, whatever it is that you want to be able to do. So I think it's really important to define what wealth actually means to you. We want to focus on potentially time, creating memories, experiences, understanding that why. I really like, again, as a planning sort of tool, the Wheel of Life. If you Google it, you'll find more information on it, but it gives you some different areas of your life, and you can rank them on a scale of 1 to 10. And you can go through and say, how happy am I with where I am in my career or my finances or my fitness and my health? And you can actually paint a bit of a picture of areas that you might want to improve. I think, as I said, it changes massively in your 40s. We're trying to balance all these things. We're trying to balance potentially building a business, a busy career, with looking after our kids, running around after our kids, and trying to find time for ourselves, time for exercise, for the things that are important to us. It's a real challenge to do that. So I think taking that step back and understanding, what's important to you is really key. And that bit about ultimately that happiness has got to come from within. It's about what's important to you, what makes you happy, how do you want to be spending your time, and it's not potentially, I think, material things around it. So I think an important distinction to make. So definitely start with that life picture of what's important to you. Okay, so before I kind of delve into that and some questions that you can potentially ask yourself, I want to share a story with regards to one of the first clients I got at Work to Live Financial Planning. So fairly typical clients in their 40s. They came to me with a query with regards to a pension that hadn't performed particularly well. We had a conversation about where they are currently, what they wanted the future to look like, what the plans are. And at that stage, it was like, we want to do a big extension. We want to borrow some money to do this and various other things. And I knew that the clients were going on holiday for a couple of weeks. And I said, I thought it could be really useful if you sort of sit down and have a think about what you want your life to look like over the next kind of 5 years, and where you want to be and what's important to you. And we had a planning meeting a few weeks later and asked them the question, so has anything changed since we last spoke? And they essentially went, yes, everything's changed. We don't want to do the extension because we potentially want to move to the countryside and we want to do this and that, and all things that hadn't actually come out in that first meeting. I said, okay, that's great. Just out of interest, how's that come about? Because that's very different to what we spoke to in the first meeting. And they said, as stupid as it sounds, we never had the conversation together about what we wanted our life to look like. And that really stuck with me in terms of, we don't take that time to think about it. We don't have the conversation. The people have been together, they had kids, been together for years. How often do you have the conversations about what that life looks like? What would a great life be to you? So it's definitely something that we want to focus on and get an understanding of it. So some of the things you can be thinking about is, how do you want to be spending your time? What matters to you the most? What brings you happiness? And if you were 5 years in the future and looking back, what would have been some of the highlights? Or if it was all to end tomorrow, what would you regret not having done, or the person you could have been? These things can really start to think about it. And there's a really good book by a person called Nancy Klein called Time to Think. It's all about giving people the space to actually think and explore their thinking and what's important to them. And I think that's one of the areas that a financial planner can really help people, is to give them that space, ask those questions, help them explore, gain new insights, because how often you actually truly listen to about what you want without any judgment. So really important questions to ask, really important things to think about, but actually take that time to think about what really matters to you, because I think it's going to be really important when you move forward into the financial planning bit and understanding what you want to do. Because like I say, money is just the fuel. It's not the ultimate destination. Okay, so where we're currently at is in the now. We're earning a salary, or we're running a business, or whatever, something bringing in income and money into the household, and we're using that to spend, to live the life that we want to live, potentially using it to pay down some debt. Hopefully that's kind of a mortgage debt rather than anything that's higher interest, but paying down the debt, and then also using it to try and build up our assets on our capital for the future. So that money's got to cover all those three elements, because at some point in the future, if you want to stop working, hopefully the debt has disappeared, but you're not earning. So what you own, the assets and the capital that you have to cover your spending and get you the life that you want, and not essentially run out of money. So at the moment, your income is doing everything. At some point, your assets are, which is why it's really important that we look at our assets and building those up so we have more options in the future. Okay, so the $1 million question of how much is enough? Okay, what's your number? What do you need to be accruing? So, see, very unique to each person. It's a very simplistic example, but it's a useful rule of thumb to start you thinking about it. And essentially, the rule of 375 is take what your monthly expenses would be, or what you'd want to be able to spend, and times that by 375. And assuming a 4% withdrawal rate, you shouldn't run out of money doing it that way. And it takes account for a little bit of tax if it's being drawn from a pension. So that's where the numbers come from. I've done a post on it, but it's a good rule of thumb to get you thinking about how much you might need. Now, yes, your mortgage may have been paid off, but you're still going to have lifestyle expenses, living expenses as well. And if you're anything like me, you sort of see some of these numbers and you think, crikey, that looks like a really big number, but at least you've got a plan to start building out. How do I get towards that number? What do I need to be doing? Obviously, in terms of the work I do with clients, we get much more granular on that and more specific around that and how we can build that out, because you might want to spend more earlier on and spend less later, and other things that you want to be. But it's a good starting point, and it's a good starting point to get you people thinking about where they need to be. And again, it comes back to understanding that lifestyle that you potentially want. But if nothing else, take your expenses or what you spend now, maybe take away your mortgage, times that by 375, and that's going to give you a ballpark of the kind of capital you might need to be having in place when you're older. Okay, so this is a really important distinction for me when it comes to money, that difference between looking rich and being wealthy. So on the right, we've got person essentially spending all that they earn, big house, fast cars, but actually what we don't know is that there's a load of debt or payments on the car. They live in a really luxury lifestyle, but they're really stressed and they're constantly worrying about money. And every time they get an increase in money, they end up spending more, working all the time. They're not actually investing anything for the long term. Whereas on the right-hand side, you've got someone who's on the outside doesn't look to be doing potentially as well, but is spending less than they earn, has a nice lifestyle, a nice car, but no real debt in place, but it's actually spending the time doing what makes them happy and enjoying themselves, but also investing money each year and building that long-term wealth. So I think that's an important distinction to make between looking rich and being wealthy, and again, understanding what wealth means to you in terms of what's important to you. And again, a really big challenge when you're in your 40s is that lifestyle creep of increasing income, but also your spending increasing alongside of that. And there's a lot of evidence to suggest that actually the more money you spend after a certain point doesn't make you any happier. And I think sometimes we can lose sight of that. I'm certainly sometimes guilty of this, always looking for more or wanting more. And actually, if we took a step back and we were 5 years in the past looking at now, we'd be like, oh, that's great. We're really happy. So I would say be careful not to move the goalposts. You don't always need a better house or a better car on that side of it. If you look back again in the past and seeing where you are now, you think, oh, that's really great. But we can sometimes move those goalposts. So I think being really clear on what's important to you, how do you want to be spending your money? Are you spending your money in things that are bringing you happiness and aligning with your values? If you want to know what's important to you, look where you're spending your money and look in your calendar and where you're spending your time, and that will tell you what your current priorities are. And the good news is you can always make changes to that, because we want to make sure we're aligning the money we're spending with the life that we want to live and the wealth that we also want to be building in the background. So I think a really important thing to avoid that lifestyle creep. And also I say, have a plan in place. If you do know that you're going to have bonuses, how you're going to divvy that up. If you can have an increase in income, likely with your career, how could you potentially portion that up? Because you do want to have some benefit. So maybe you want to assign a little bit to improve lifestyle, and then some to savings and some to investments. So having a plan for that money before it comes in, because once it comes in, if you're not assigning it to go somewhere, it's essentially going to be disappearing. It's going to get spent. So really being in control of your spending is a really important factor in building wealth in your 40s. Okay, so I've got to mention kind of at the start, there's a few assumptions that I'm making for people when we're talking about building wealth. The first one is that you are kind of in control of your spending. You've got more income coming in than going out, that you've got some cash savings in place, maybe 3 to 6 months as an emergency buffer on that side of it. But one of the key things when you are building your wealth is to make sure that you've got the right insurances in place. There's nothing that's more surefire to blow up any financial plan when you're in your 40s than losing that income and your ability to earn. You are the biggest driver of your ability to build wealth over the long term, your income is essentially. So you think about it, if you had a cash machine at the bottom of your garden that paid you out every week or every month, would you insure that cash machine? I'm pretty certain that you would. And you are essentially your own cash machine. So have you got the right insurances in place? The three main ones to think about: you've got life cover, critical illness cover, and income protection as well. So it's making sure you've got the right foundations in place so that your loved ones, your family will be taken care of. God forbid, should the worst happen, if you weren't able to work, that you would still have income coming in to protect the assets that you've got. So don't overlook insurance as part of that strategy when you're looking to build your long-term wealth. It's really important. Okay, so I think it's also important to make a distinction between saving and investing. And saving is obviously important. You need to have cash, you need to have the buffer, and you might want to have a certain level of savings and cash to give you that comfort level and that peace of mind. But over the long term, the thing that's going to build you real wealth is looking to investing that money with the potential to achieve higher returns. And if you can see in the example, because of compounding over time, that makes a real difference in terms of what your wealth will be at the end of it. You're still putting the same amount of money away, but you're getting it to work harder for you and you're getting more for it in the end. And one thing you don't want to ever forget is that what we call the silent assassin, which is inflation, which erodes the real spending power of your money. And typically the returns that you would get on cash or savings tends to not really keep pace with inflation, or just about keeps pace with inflation. If you want to be building real wealth above and beyond inflation, it's probably where you're going to need to be looking at investing. So we're going to touch on that in a little bit. So what are your main investing options or vehicles in your 40s? The two staples is the ISA and the pension. Pros and cons to both, but both have tax-free growth in that. With an ISA, you get £20,000 allowance each year and no tax relief on the money on the way in, but then you're not taxed on money on the way out, and you can access it at any time. The pensions, you could essentially put £60,000 in, subject to the rules and how much you're earning. You get tax relief at potentially 20%, 40%, or 45%. Or if you're caught on that horrible 100 to 125,000 band, potentially 60%. So a really good vehicle tax-wise for your money. Downside being, can't access that until, at the moment, it'll be 57, potentially 58. Good news, you get 25% tax-free, but the rest of it would be taxed on withdrawals at whatever your marginal rate is. But a really good vehicle if you can use them, and probably the starting point for most people in their 40s. And to mention, with the ISIS, you and your spouse would get your own allowance each year. So potentially that's 40,000 between the two of you. So both really good vehicles for you on that point. Okay, so I think a lot of the reason why people originally signed up for the webinar was a post I did around overpaying the mortgage versus potentially investing that money and putting it into say a pension. Okay, and really the purpose of that was just to highlight the difference between the two and different approaches, not to say that one was right or one was wrong. It was more to sort of help people sort of understand it and their options. Because I think one of the things that you really want to do when you're in your 40s is be able to make informed choices around the financial decisions that you make. You might decide that you want to spend more now, but that means you're going to work longer or invest more so that you could potentially stop work. It's a variety of choices that people have to make. Do I overpay my mortgage, or do I invest that money into pensions? It's going to be unique to your circumstances. It's going to be unique to your situation. It's going to be unique to what's important to you. So I always use example with mortgages that in America, they have mortgage repayment parties. When people have cleared their mortgage, they throw a big party to celebrate it. I don't think anyone does that when they get hit a certain amount in terms of their investment. So that emotional aspect of owning a property, feeling like I've got that security, that might override something that in black and white terms would potentially not make sense. But it's about being what's right for you. But for me, it's about making those informed choices and understanding the impact of the different financial decisions that you make further down the line, so you can come to the best choice for you and for your situation. Okay, so I'm going to touch now on investing, and I can't go through everything at this moment. I'm hopefully going to do some more webinars around investing so we can get into some more of the specifics. But a few things that is worth noting, I've touched on this before and I'll expand on it in a little bit, that global equities or equities are going to drive those long-term returns that you need to build wealth above inflation and protect the real spending power. You want to really understand your level of risk and your risk appetite, but also with the timeframes that you want to invest. So when I'm talking about risk when it comes to investing, I'm essentially talking about increased risk being increased volatility, how bumpy it is, but actually there are other very real risks, as I've touched on: inflation eroding the value of your wealth, not investing enough, not getting the returns that you need to achieve the lifestyle that you want, or you've invested everything in one company rather than spreading it out and being diversified. So it's really important, I think, for people to understand the investment journey that they're going to go on, how it actually works in reality, and what's going to give you the best chance of achieving what you need. And what is that relationship between risk and return? And essentially, if you're increasing the level of equities, you're increasing the bumpier journey that you're going to go on, but the potential for returns are going to be higher. And that's a really important relationship to understand. It's going to be just a more bumpy journey, for want of a better word. And we kind of know from history that over a 12-month period, stock market typically goes up around 75% of the time, and it declines 25% of the time. And that's really highlighted in this graph on the right-hand side for the S&P, that's showing the sort of the maximum fall in 1 year, the lowest it got to, and then what it ended the year on. And although the average drop is around 14%, that the returns were positive in 33 of the 44 years. So again, it's really important why that how long you're going to be invested in that time frame in terms of being a successful investor. And if you're in your 40s, you do have that time on your side, you do have that time frame, you can take that long-term view on it. But again, there will be falls, there will be dips within investment markets and with everything that's happened. But also, if you are accumulating wealth, that's not a bad thing for you, because if you're continuing to invest and continuing to put money in, potentially you're buying at a discount. So actually buying more assets for less, and because you're looking at it long term, benefiting from that long-term growth. So actually for accumulators, those fall in value, although they're not pleasant. If you've got a decent amount of capital already accrued, if you continue to investing and be able to buy assets and be disciplined, is actually going to help you build that wealth long term. So that's a really important thing to understand as well. Okay, so I touched on this a little bit in terms of equities, and equities being the driver. So this is some different asset classes and the long-term returns over a 30-year period. You've got inflation and cash at the bottom. You can see that pretty much is the same. So if you're investing in cash, you've just about kept the spending power of it, but you've not actually built any real wealth. Then you've got your bonds, you've got your equities on that side of things as well. And different equities have returned different things. So this is not to say that you should, because it's done the best, be all in US equities. It's just showing you that equities are going to be the ones that drive the return through everything that you've got. So a bond, for example, would be classed as a less risky asset. But if anyone can go back and remember when Liz Truss came in with her budget, actually there were quite significant falls in the bond market and that side of it. So it's not risk free, and it's important to make that distinction. So getting that right balance between your investment, making sure you're invested across different equity classes in different geographic regions is really important. But yes, you need to be looking at equities as probably the main driver to build that long-term wealth for you. Okay, so there's a lot of things that we can't control when it comes to investing, in terms of changes in the budget, geopolitical things, who's going to be elected president of the United States, tax changes, all these things. But there are certain things that you can focus on, and you should focus on what's actually in your control. So really big one, and actually probably the most important factor, is your current investment rate, how much you're actually putting aside at the moment. The more you can put aside, obviously, the greater benefit you're going to have. So I think that investing rate is really important to focus on, even more than the investment returns. Get that investing rate as high as you can, almost at the point where it's maybe slightly uncomfortable, because that's really going to pay off longer term. And keep those investing costs as low as possible. Being globally diversified, investing in equities, again, focusing on that long-term approach and being as tax efficient as possible when it comes to how you set up your investments, but also how does it fit into your financial plan, what you want to achieve, and the investment return that you need. It's not what Dave down the pub said that they got, or that what the top performing fund was that year. It's about, are you on track to live the life that you want by doing the things that you are doing? That's the only benchmark that you need to worry about, and the only return that you should be focusing on. What do you need over the long term? So really important distinction to make. It's not about chasing more wealth or more returns just for the sake of it. Equally, some things to avoid when it comes to investing: just investing in the latest fad, avoiding investing what's always worked, which is a globally diversified portfolio with a significant weight in equities, investing in the great companies of the world, your Apple, your Tesla, whatever it may be, making sure you're really diversified, trying to time the markets. Evidence shows that's not a successful approach. Constantly making changes, constantly trying to seek the top returns, moving to that fund because it did better this year. It's easy to make some mistakes. It's about being disciplined, maintaining focus. And the other one is also not paying high fees for your funds. A lot of evidence around active management versus passives, and that they don't generate the returns when you take into account costs. So really important, and the fact you can control, is the underlying cost of your investments, and how does that fit in with the returns that you need? Is it the right approach? And having an investment philosophy that you can stick to is really important as well. So definitely a few things to avoid. Keep it simple, focus long term, keep your costs low, be globally diversified. you can have a pretty good chance of achieving what you want to achieve. And as I touched on before, I think it's actually investment behavior that's going to be a real driver of your success and your ability to build your wealth. I touched on before, investments go up and they fall, and we go through a whole range of emotions for it. You're geared up basically to be a bad investor as a human. You're not designed to be a successful investor. And what happens is when markets are doing well, everyone's piling in and everything's great and they jump on it. Markets go through those natural falls that they will experience from time to time. People sell out, markets go back up, everything looks great again, they buy in, same thing happens, they sell out. So they're buying high, selling low constantly, and essentially that's a surefire way to not build your wealth successfully. You want to maintain discipline, maintain your focus, ignore all the noise, all the press noise, all the talk of Armageddon, all the projections. Focus on you, what you can control, keep disciplined and keep level, and that's how you're going to be a successful investor and go through those market cycles that then they're naturally going to happen over time. Okay, so tax planning in 40s, I think obviously a really big area for people, and there's lots of things that people can potentially look at. So we touched on the ISAs, you've got your pension as well for people who are 40%, 45% taxpayer or caught in that 60% trap. Really important vehicle to be making use of. Can actually use allowances from previous years if you've not used your full pension allowances. So that could be possible. You've got to make sure that you've got enough earnings to make that justifiable to do it, but that's a potential option for you. RSU, so let's say that you're a senior executive and part of your remuneration is with regards to share options or RSUs. There may be some tax planning around that. Do you vest them when they become available so that you can put them into ISAs? It can also help with diversifying your portfolio as well. So various things that you can do. Business owners, pensions still pretty much a no-brainer. Corporation tax relief, no personal tax to pay on it. You're not paying national insurance contributions. And again, if you've got life insurance as a business owner of a limited company, and you're paying that personally, should be having a look at relevant life insurance, similar tax reliefs available for that. Where it can be challenging for people on people who are earning over 260,000 with the change to pension rules, the pension allowance can be tapered down to essentially 10,000. So really restricted in how much you can put into pensions. So you may need to look at other options with regards to EIS VCTs, which are higher risk investments, but do have some tax advantages to it. The other thing I didn't mention before is potentially looking at your spouse as their own little investment vehicle if they're not working or whatever it may be on that side of things. But it's always important to not let the tax tail wag the investment dog. Okay, so the investment shouldn't be driven solely from the tax angle of it. How does it fit into your plan? Is it still the right approach? And the one thing that might become more important or people start making more use of with the changes around capital gains tax is investment bonds, offshore and onshore. So a lot of tax planning opportunities. It's an area that obviously I help a lot of clients with. What's the right options? How do we minimize tax on that side of it? So 40s, really important that you're doing the right sort of tax planning as well. Okay, so coming towards the end now, I'm going to talk a little bit around estate planning, which again is something that's often overlooked. Do you have wills in place? Is it appropriate? Is it still suitable? Does it actually represent the complexity potentially of your situation? Power of attorney. What I would say is with estate planning, what was right potentially a few years ago may not be right now. So changing circumstances, are the kids going to be inheriting more money? Are you comfortable with them having that money? Let's say that they're in their teenage years and they could potentially have that at 18. How happy would you be for them to have what could potentially be a significant amount of wealth? Do you need to do some trust planning? Is there a need for trust? So I think looking at that estate plan is really important, and it's going to become more important further down the line. Inheritance tax would be typically something you think about with potentially parents or older people, but actually it's something that you might need to be thinking about now, especially again with changes in the pension legislation in terms of them potentially coming into your estate for inheritance tax purposes in a couple of years. So definitely an important thing to be thinking about. Starting point is, are the wills right? Who do you want to be taking care of your kids? Again, make sure you've got those basics in place. And then some other considerations. Again, you might be considering selling a business. What impact is that going to have? I want to plan for your children's education. supporting elderly parents? Is that either potentially financially or actually physically, in terms of needing to be there and support them with their care, receiving inheritance? There's a lot of things that could potentially happen over the next few years, which is why financial planning and getting help could be really useful for you. And for me, in your 40s, it's all about finding that balance, isn't it? Between you want to live a great life now, but also do the right things and preparing for the future. You don't want to put everything off and not enjoy yourself in case you don't get to the age that you were planning to do everything and something has happened to you. You're not fit and healthy enough to enjoy it. And equally, you don't want to live so free and wild now that you're not actually putting in place the foundations and the stuff that you need to do. So you've got more options and more choices in the future. So I think financial planning in the 40s is really about creating those options and having more choices further down the line for your future self. And it can be difficult because the future person is almost like a stranger to us. So sometimes we really focus in on the now, but it's really important that you know what kind of track and what path that you're on. And equally, I would also say, if you know that you're doing the right things for the future, that's going to put you in the ballpark, potentially that frees you up to spend more money now and not feel guilty about it and be able to enjoy yourself. So definitely a balance between the two. I think one of the biggest challenges that people have in their 40s is finding that balance on that side of things. Okay, so I want to share a little bit about Work to Live financial planning and some of the ways that we help clients. So I set up the business 5 years ago to deliver financial planning how I wanted it to be delivered, to keep it kind of informal, relaxed, but with that expert advice, because I appreciate talking to a stranger about your finances can be difficult. It's something that we not wanted to deal with. So the approach I wanted to take and have that life-focused approach about what the money's for. So some of the things that we help clients with is that life planning bit, understanding that visions and values, giving them the time to think about what they want, what are the future events, what do we need to be planning, and map that out so they can see the big picture, the wealth strategy that they need, have they got the right insurances in place, doing that tax and pension planning, making sure we're being as tax efficient as possible, help with what are the right investments, what are the right pensions to get them where they need to be to achieve the returns that they need to be, implement that. And for me, financial planning is an ongoing process. It's not a one-off. Like, life is constantly changing. We're constantly having to respond and adapt. What's important to us change, our values change, our potential goals change in the future. So it's an ongoing journey when it comes to your financial planning. But that is pretty much the approach that we take and some of the areas that we help our clients with. And then finally, if you are interested in working with us, there's some good studies out there around the value of advice and the benefit of taking financial advice from the Royal London and also Vanguard in terms of that tax planning, that asset allocation, that behavioral piece. They put it around 3% per annum. So they value it quite highly on that side of it. And the first steps is just to book in a call. I'll put a call link in the comment section of this video. Book in, we'll have a 20-minute chat, find out a bit about what you're looking at, and if we feel like we're the right fit, then we can move it towards a 60-minute, what we call discovery meeting, so we can delve in a bit more around those plans, what you're trying to achieve. And there's no cost for those meetings. And then we put a proposal together if we feel like we can help you, highlight some areas that potentially you could improve, and then we discuss how we can potentially work together. So if you are interested in reaching out and having a chat with us, the first step is just a 20-minute informal chat, and we can take it from there and hopefully provide some help for you along the way. So just to wrap up before I move on to any questions, so what are some of the things that you need to be thinking about in your 40s? You need to understand what you want to achieve and what an ideal life looks like. What is your life plan? Know your priorities, understand your numbers, understand where you are currently and where you need to get the right insurances in place is a big one. Build out that wealth strategy, do the tax planning, regularly review and update your plan. And if it's appropriate due to complexity of your life or your comfort levels, potentially working with a financial planner to help you build your wealth whilst living that great life, because that's what it's all about. And just remember, and the phrase, plan's great until that first contact with the enemy. There's going to be curveballs, there's going to be things that happen. It's not all smooth sailing. And the important thing is to do the planning rather than the plan. The planning is where the real magic happens. So I'm really sorry about the issues with regards to setting that up. I hope it was useful for the people that did manage to attend. I'll send out the recording to people. If there are any questions, do let us know. I'll have a look on the comment section to see if I can figure out how we do that. And yeah, thanks for your time for those of you who did manage to jump on and attend. And again, apologies that it wasn't quite as slick as I was hoping it would be. Okay, so I don't know if there's any questions. I can't see any in the comments. Might be something to think about in terms of that. So I'll stay on for a couple more minutes, and then if anyone does any questions, do just drop them in the comments. Hopefully that will work. If anyone does have any questions, drop them in the comments and I'll respond to you via a DM. But thanks, everybody. I'll speak to you soon.